let's talk about affordability of borrowing money for cash flow oriented outcomes. Hey, this is Justin Hitt from Sustainable Wealth Secrets. Boy, that introduction's a mouthful. Really what I'm doing here is I'm going over some of the things you want to think about before you borrow money. And the big question came to mind is, how come I can afford to borrow $66,835, but I can't afford to borrow $45,000 for a $60,000 asset? So I was looking at some properties and I found a nice little house that's being sold under market for $45,000. Now, I did some research and some homework. The house is easily worth $60,000, but the owner doesn't want to sell through a real estate agent. They just want to sell the house quick. They just want $45,000 in cash, and they're ready to go. Now, normally what I would do is I would get a contract on the house and give them the $45,000, and then I would clean the house up real quick and sell it. Now, I've not done this before. Usually I buy and hold, but I know people who will buy a house, control it, and then overall turn around and sell the house. Sometimes they don't even pay the owner. They basically write a contract and sell the house for the person. The second option I could have done is I could have got an agreement or a contract with the owner to sell the house for them, and then upon sale, give them the $45,000 that they want. There's all kinds of options and puts and different things you could do. Give them $10,000 in cash now, and rent the house from them under a rent-to-own agreement. There's like 1,000 different things to do. But the biggest question that you've got to ask is, would this additional debt, whether it's in a contract where you're going to buy it no matter what, whether it's in a loan that you get from the bank, whether it is money you take out of savings, what is the cost of that capital? Now, buying a house, you have the insurance associated with the house. You have the interest on the loan. If you have a loan, you have the property taxes that will be due. You have a lot of factors that go into the purchase of an asset. Now, if I want to guarantee my $60,000 return, I have a window of about $20,000 that I can spend in order to tune that house up. So I have to also ask the question, could I tune this house up, get it cosmetically right, get it where it needs to be? See, one of the reasons they don't want to work with real estate people is because the real estate people say, look, it's a small house. You need to do these remodels. They don't want to do remodels. They just want $45,000. And in their mind, what they're looking at is, I'm going to sell this property. It is clearly worth $60,000. I should be able to get $60,000. But I don't want all the hassle of looking around or dealing with people. I just want my 45 and walk away. So there's a lot of things that could be distractions. Now, the bigger question is what the impact will be on your cash flow to have this additional loan. So if I'm buying the house to rent it out, I've got the cost to get it prepared for my tenant. I've got the what I can get rent in the marketplace. I've got a lot of factors. See, I know people out there who will just say, $60,000 house for $45,000, I'm buying it. Well, again, if we're looking at current value of money, future value of money, we're looking at inflation in the marketplace, cost of capital, we're looking at how it impacts our cash flow, we got to make different decisions. Now, I couldn't afford to borrow $45,000. Now, what does that mean? Well, it means that the down payment, the actual payment, and then the costs associated with the purchase of the asset wouldn't hit cash flow fast enough to be worth it. Second, and now it's up to you, you decide. Second, if it significantly changes my payment to income ratio, now buying it as a rental would increase my income, and it's possible for my income to increase much further than my month-to-month costs, but I'd have to take a certain amount of cash out to do the payments, to do the repairs, or I would have to use credit to do the repairs, which would create additional payments. All of those payments together would take me above my comfort threshold, which is no greater than 40% of your income going out to debt service. Do you see how we're working here? We're thinking through from a finance and economics perspective whether or not we should borrow money. Now, in past programs, I've talked about how do you borrow money to buy assets that cash flow that essentially pay back the original loan. if I'm considering that on this house, yes, I could have produced that, but there's also the time factor. Now, let's talk about the $66,835 loan. The reason I can move forward with that is because $66,839 at 9% is $1,876 a month in payments. And the only question I need to look at here is that payment going to be less than what I'm currently paying on the same amount of money as it's allocated in my portfolio. So you folks know, the ones that are involved in the debt management program, you know I've got a spreadsheet of all the liabilities, their interest rates, what are the payment amounts. And so now the question becomes, I'm not creating additional debt. So this $66,000 will pay off higher interest money. So there's money that's operating expense on credit cards, or there could be, higher interest rate debts. Now, I don't have very many debts that are higher interest rate than 9%, but the thing that I'm pointing out here is I do have some expenses that have very high payments on them. And so I have this one loan for $21,000 at 5.25% with a $579 a month payment. That payment is inefficient for that size loan. It means that $579 could be working harder someplace else. And so how do I free up that cash to either pay down debt in general or to pay into assets that already cash flow? See, I already have rental property. I already have homes and different properties that could be improved. And by improving those properties, I'm able to increase their value and then increase their income. And then that increases my threshold to which I could borrow in a very conservative, safe manner. I hope you're following along here, because the questions that I'm asking to borrow money that will replace debt are different than the questions you might ask to buy an asset that cash flows. Both are good uses of money, but you want to find out where the ratios are correct, because I could borrow $45,000 at 9% for a $943 payment. That's over 5 years. I could borrow the $66,835 at 11% and only have a $1,200 a month payment. And if I'm looking at my cash flow position, in order to free up cash now to invest either in debt reduction or into increasing the cash flow on existing assets, I'm going to take the consolidation, because the consolidation frees up $475 a month in cash flow. Now listen carefully. I'm already making the payments on $66,835 in debt. It doesn't matter what the numbers are to you. Some of my clients, the number is $250,000. They're already making payments on $250,000 in 12 different loans. And if they consolidate those into $250,000, one loan, they're going to cut $600 a month off their payments. Their interest rate goes down, so the cost of capital goes down. And overall, that's a better choice. Now, assuming they've done what's necessary to not have those expenses come up again. So there's the other element is don't create more expenses, and let's stop spending money on stuff that doesn't cash flow. See, the whole mentality of Sustainable Wealth Secrets is not to borrow money, is not to spend money, is not to lend money, is not to invest. It is to make financial decisions with your money that multiplies the value of your investment. So if you're going to buy this rental property that I found that was under market, the day I purchased that property, I would have equity in that property. In fact, if they wrote a contract for $66,000 and that we did a cash back at closing, I could have had the cash in the mortgage for the house to pay for the repairs, and then had a income increase from the cash flow. And on paper, it sounds great. You can sell somebody a how to get rich in real estate program that explains that. But if you don't sit down and look at what is the time investment, what are the skill sets that are necessary to do that? Does this fit into the longer term plan of everything else I own or everything else you own? Does it fit in your portfolio as far as eligibility with banks or with lenders or investors so that you don't overextend yourself? What are we looking at from the financial forecast? These additional questions is what takes you from, just making a dollar to sustaining wealth. For every dollar you have, for you to be able to multiply it and to grow that investment. So this $66,000 is not new debt, and it is at a rate lower than the cost of capital of this segment. And you really can't see it here, but I highlighted some of the loans that will get paid off. And these loans, the cost of capital for this slice of loans or this portfolio of loans is actually far greater than 9.43%. And basically, we're looking at maybe 12%. Now, there's not a lot of spread there because I do a good job of managing out my available credit. But ultimately, I will save on the interest. So my cost for the loan over time is less. My equivalent payments are less. And overall, since I'm not having a problem making the original payments, I'm not going to have problems making the other payments, even though it's all lumped in one chunk. Now, in the back of your mind, you might be thinking, well, I don't want to pay $1,800 a month in payments. No, you're already paying $1,800 a month in payments. Now you're going to be paying less. You're going to be paying less than the original. So what was my original number? I think it's $2,000. $2,013 a month was my original payments. This replacement will give me at $1,876. If I take an option and do the 6-year loan, I'll have a $1,200 payment. You see my spread, how it works there. Now, I didn't just get there. I have A, B, C, D solution. I looked at borrowing 45. I looked at borrowing 73. I looked at borrowing 81. I looked at borrowing 66. The position you really want to be in, and the biggest lesson and takeaway of this, is you want to always be in a position where you can walk into a bank and they cut you a check. Okay? So if I bought that other house, I could compromise my position. It's great to have a high credit score. It's great to have a available cash flow. It's great to have a high income. It's great to have a low payment to income ratio. But don't push your limits, because it's even better to walk into a bank, to walk into a lending house, and basically they cut a check. That check, you apply it according to your plan, and we can talk more about how to do that plan, and it cuts out a segment of debt by consolidating it or bundling it up. The debt's not going to grow anymore because you've addressed the cash flow issues, you addressed the expense issues, and now you're able to pay that debt off in a fixed period of time. Now, because I know inflation is coming, for those of you involved in the commission about profit from inflation, we talked about this specifically. We know inflation is coming. We see the signs of inflation. I'd rather have a fixed rate loan than have credit cards with variable rates. So that's another factor that's in there. Now, the decision to borrow the $66,835 is, again, a decision to increase my cash flow. It is to lower my cost of capital. It is a decision that helps manage payments better. One payment directly withdrawn to a single account is better than 6 payments directly withdrawn to 6 accounts. And ultimately, to shore up credit score as well, because I'm changing the type of debt. I'm going from consumer debt. Sometimes I'll have things repaired at the house on a consumer account because it's convenient and because they'll comp me additional benefits than it is to just pay cash. Even though the cash is available, I pay it on the consumer account and then I cash it out, or I will roll it into something because there's also structure involved here. I don't really have a lot of time to go into some of the other factors, but all these factors can be drawn out in a matrix. And so depending on what you're trying to purchase or what you're going to use the capital for, you can actually model out the cost of capital, the increase or decrease in cash flow, and the kind of the structure of how it's going to work. Is the company going to borrow the money? Are you going to borrow it in a real estate investment or as a new investment property? Or are you going to borrow it as yourself as an individual? And then there's other cases if you have a trust or a family office, different things like that. My point being is, you're never just going to go out and borrow money. You're going to get yourself in a position where you could just go out and get another credit card with a $100,000 limit on it or $50,000 limit on it. But you're not going to, because you're going to make decisions about how you apply your capital so that that capital continues to multiply. Now, this extra cash flow I found, what am I going to do with it? Well, I've got that planned out as well. I'm going to build up a stronger reserve to pay off that, to maintain debt service. But because of inflation coming, I'm going to make sure that reserve is in some kind of investment that inflation adjusts and produces enough cash flow to cover the loan obligations. Because with inflation coming, I don't want to pay off all the loans right away. Because paying off the loans now with money that has okay buying power is not as exciting as paying off loans in the future with money that has less buying power. Because again, your loan is a contract, and being that it's a contract, terms aren't going to change. Now, the bank could call your loans, but it's not going to change just because there's inflation. So again, I hope I'm answering the question. If I can't afford to borrow $45,000 to buy a house that's worth $60,000, how come I can borrow $66,000 to apply towards the other option, which is consolidating debt, reducing cost of capital, increasing cash flow, and ultimately working towards a better plan. In fact, this particular move here reduces my payoff period, so my period to zero, to the 5 or 6 years of the term. I basically was able to roll up all consumer debt, some business debt, and actually mostly business debt, rolling up basic business debt at a lower rate than I would pay otherwise. Now, when you're using a snowball method and you're using, there are going to be times where my investing in debt by paying off debt is going to be better than investing in whatever investments I got going on that is increasing income. But again, it's decisions. It is decisions. And it may not make any sense. If you can't borrow 45, why are you going to borrow 66? Well, can't also can mean won't. And the reason I won't is because of, again, the holding costs, the cost to close the loan itself, the type of debt in relation to the amount of cash flow I can produce from it. There's a lot of factors that go in there, a lot of things to consider. But again, once you get used to doing this, it becomes like second nature. And you're going to see opportunities pop up out of the woodwork. Because I'm lowering my cost of I'm increasing my cash flow and lowering my cost of capital and improving all my ratios with this, it doesn't mean I can't go back later and still go buy the house. Do you see how that works? A payment on a $45,000 house is going to be about $500 a month. I freed up about $500 a month in cash flow. Now I can afford to buy it. Now I'm not going to. It doesn't fit in the larger picture of things. But if the opportunity exists in 6 months, who knows? It's about making decisions. It's about focusing on outcomes. It's about having a plan. And that's how we get to sustainable wealth. I want to thank you for listening. I'm Justin Hitt with Sustainable Wealth Secrets. If you're not already a subscriber of what we're doing, where we have custom plans, we might even talk about, and I'll show you how to lay out this kind of stuff. We have group Q&A calls. We are able to take your high income and transform it into net worth. Now, with inflation coming, you may not want net worth. What you may want is assets that cash flow and raw material production. But we can talk about that more later. I got a report coming out soon. It's being commissioned right now for some private clients called Profit from Inflation. It shows you how to increase your net worth. See, that's tricky. Your net worth is going to increase during inflation. But I want you to be able to actually have real net worth that after the inflationary event ends, whether it's 5 years, 10 years, or whatever, you still have wealth. And that during the inflationary period, you still have wealth. That's kind of the premise of Sustainable Wealth Secrets. Anyway, visit us at www.sustainablewealthsecrets.com. Get involved in what we've got as far as newsletters. Get involved as far as what we got on membership sites, and you'll be able to ask your questions there. Again, I'm Justin Hitt with Sustainable Wealth Secrets. Thanks for listening.